When you get injured and it's not your fault, the last thing you should be worrying about is money, right? Your focus should be on getting better. But what happens to your income? In this explainer, we're going to cut through all the jargon and show you exactly how lost earnings claims work in Scotland, and most importantly, how you can protect your financial future.
I mean, let's be real. An injury is so much more than just the physical pain. It can turn into a full-blown financial crisis, and fast, especially if you have a physical job or maybe you're self-employed. If your income depends on you being 100%, the impact can be absolutely devastating.
Okay, but here's the good news, and it's really good news. In Scotland, the law on this is crystal clear. It's specifically designed to protect you, the person who's been injured. And this right here, this is the core principle of the whole thing. It's not about getting a bonus or some kind of lottery win. No way. It's about fairness. The entire goal of compensation is to put you back to where you would have been financially if that accident had never happened. And your lost earnings, they are a huge part of that equation.
So how does this actually work when you make a claim? Well, it's kind of helpful to think of it as having two different timelines. The law literally splits it into two parts: the money you've already lost and the money you're likely to lose down the road. And splitting it up like this is absolutely crucial. Past loss is all about looking backwards. We're calculating the real concrete financial damage from the date of the accident right up until today. Then you've got future loss, which is all about looking forward. It's about projecting and protecting your financial stability for the years ahead.
All right, let's dig into that first part, your past loss. This is all about what you're owed right now. This is usually the more straightforward piece of the puzzle, but trust me, getting the calculation right is essential. Okay, so here's a really important point. We're not talking about your gross pay. We're talking about your net loss, your take-home pay. Why? Well, because any compensation you get for a personal injury isn't taxed. So the calculation is based on your net pay to make sure everything's fair. It's simply the gap between your normal take-home pay and whatever you actually got, like statutory sick pay.
So how do you actually prove all this? Well, it's pretty simple. Paperwork, paperwork, paperwork. Payslips, letters from your boss, records of sick pay. All of this builds an undeniable picture of what you've lost. The more evidence you have, the stronger your claim is. Oh, and don't forget about regular overtime or bonuses. If those were a normal, predictable part of your income, they absolutely count.
Okay, but here's a question I hear all the time. What if my job paid my full salary while I was off work? I didn't actually lose anything, right? It seems like a simple no, but the answer is usually, yes, you did.
It's thanks to something called employer recoupment. Think of it this way. Your employer took the financial hit by paying you when you couldn't work. So that wage loss is still included in your claim, but that part of the compensation goes straight to your employer to pay them back. It means you haven't lost out and neither have they. It's just making everyone whole again.
All right, so we've covered the past, now let's look at the future. And honestly, this can be more complicated, but it's often the biggest, most significant part of a claim, figuring out your future loss of earnings. The whole calculation starts with something called the multiplicand. Yeah, it sounds like a complicated legal term, but it's not. It's just your annual net financial loss. So if your injury means you can't work again, that number is your entire annual take-home pay. If you can still work but earn less, it's the difference between the old you and the new you. Next, you take that annual loss and you multiply it by a special figure called the multiplier. And no, this isn't just a number pulled out of thin air. It comes from something called the Ogden tables, which is the official tables the courts use for these calculations. It takes into account your age, how many years you have left to work, and the fact that you're getting all this money in one lump sum today.
So when you put it all together, the calculation is actually pretty straightforward. You take your annual loss, that's the multiplicand, and you multiply it by that special age factor, the multiplier. And boom, that gives you your final award. It's a really clever way of turning years and years of future lost income into a single, fair figure right now.
Okay, so that formula is great, but life isn't always that neat and tidy, is it? Let's talk about some of the more complex situations, the hidden costs that a lot of people might miss, but that the law in Scotland makes sure to cover. This is a huge one. What if you're back at your old job? You're back at your desk earning the same money. You might think, well, I'm earning again, so that's the end of it. But not so fast.
This is where something called a Smith versus Manchester award comes in. Think of it as a safety net. It compensates you for the risk that if you ever lost your current job, your injury would put you at a serious disadvantage out there on the open job market. It's a lump sum that recognizes your future is just, well, it's more vulnerable now.
Now, if you're self-employed, I'm talking to you right now, the basic idea is exactly the same, but the way you prove it is different. You don't have payslips, right? So instead, you'll need things like your tax returns, business accounts, invoices, bank statements, anything that helps create a clear, reliable picture of what your earnings looked like before the accident happened.
And here's something that, honestly, so many people forget about: your pension. If your injury forces you to retire early or cuts your working life short, that means fewer pension contributions over the years. That future loss is a totally legitimate part of your claim. And in serious cases, it can be a really substantial amount of money. Okay, so we've covered a lot. You might be thinking, what can I do right now to make sure I'm protected and my claim is as strong as it can possibly be? Well, let's get practical. It all comes down to being organized from day one. Here are 4 simple steps you should take immediately. Seriously, do these today. 1. Keep every single payslip. 2. Document all your time off work. 3. Save every email, every letter from your employer. And 4. If you're self-employed, call your accountant right away. A solid paper trail from the very beginning will make your claim so much stronger.
I really want to circle back to this idea one last time because it's so important. Claiming for your lost earnings is not about trying to get a bonus or some kind of extra. It is a fundamental right. It's about recovering what was taken from you because of an accident that wasn't your fault.
At the end of the day, what does this all boil down to? It's simple. Knowledge is power. Understanding how all of this works is the single most important step you can take toward making sure you get fair compensation for everything you've lost and for everything you stand to lose.
So, I'll leave you with this to think about. Now that you get the difference between past loss and future loss, and you know what kind of evidence you need, are you taking the right steps right now to protect your financial future?